Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett Fu, we survived the snowstorm.
We made it in. We both made it in.
We made it in because we need to bring you the biggest stories in the nearly 19 trillion global ETF industry. We kick off a busy week with equities rising ahead of tech earnings and gold topping $5,000 an ounce for the very first time.
And in just a few moments, we'll dig deeper into flows and volume in the precious metal ETFs with Todd Sohn, ETF strategist at Strategas.
And the issuer behind T-bill has a proposal that is pulling one of Wall Street's most regulated asset classes into the orbit of digital finance. All of that and more coming up. But you might have noticed that Eric Balchunas is not here. He is stuck in Philly. So
no Amtrak today.
No Amtrak today. I'm looking at the flows. Let's take a look at where money was moving in the week that was. And this is interesting. Up at the top, you have VU. That is to be expected, taking in about $3 billion. But then take a look at IEMG and then VWO. This is an iShares EM ETF. This is a Vanguard EM ETF. And you can see that they took in billions of dollars. So a lot of conviction building behind those bets on emerging markets. But let's take a look at what lost money as well. Up at the top, you have SPY and then you have IVV. Those are two S&P 500 tracking ETFs as well, the same as VU, but you can see that these ones lost money. And then you have tech losing about $2.4 billion as measured by the Qs. We have a busy week of tech earnings, so it's going to be interesting to see how this changes here. But let's take a look at gold. I mentioned the price action in gold has been pretty stunning. Gold topping $5,000 an ounce for the first time over the weekend. And take a look at gold flows over the past year or so. Since the end of 2024, the start of 2025, you can see that cumulative gold ETF flows have now topped $50 billion. That is your purple line here. And then you take a look at the return in gold. If you had invested basically at the beginning of 2025, you're looking at gains of more than 76%. So there's a lot of questions, Scarlett, as to whether or not we're going to see this rally in precious metals continue. But you can see that there is also a lot of money flowing into that specific bet.
Yeah, absolutely. You wonder how much longer it has to go. So joining us for our conversation now is Todd Sohn. He's the ETF strategist over at Strategas. Has the quality and the pace of fund flows into precious metal ETFs and gold specifically changed at all since last year, or does it just kind of continue at the same rate?
We are going through metal mania. And this is the beauty of ETFs, right? Whenever there is a new trend developing, a new catalyst, whatever it might be, there's usually an ETF where investors can go and get access to it. So you're seeing it in gold, you're seeing it in silver, palladium, platinum, leveraged silver, inverse silver. Everything in this whole space is getting activity and volume and flows. I think an elegant way to put this is, think about in equity land, energy and materials are 5% of the S&P 500. So almost everybody is massively underweight these categories. And I think this is entirely a catch-up trade to allocate there, especially when fixed income is a little bit challenged too.
Yeah, it's really interesting that you think about energy in particular, it seems really underloved when you take a look at the ownership in some of those names. So gold popping off, you're seeing it get attention. You think about natural gas over the weekend. It was very cold, as discussed, and natural gas responding accordingly. So when you think that, this move could sort of translate into energy flows, are those broad-based, or do you think that that would be more about equities versus the commodities themselves?
I think it's more equity to me. The problem with energy commodity ETFs is that they're not physically backed, right? You're dealing with futures roll, the tax structure of them, right? There's some hair to it. But meanwhile, if you want to get differentiated exposure, especially away from large cap growth and AI, energy's there. And if there is a second wave of inflation, we'll see, no evidence of that yet, but if oil starts to get going here, then I think there's going to be a pretty big rush back into energy, similar to what we saw back in 2020 and 2021, because folks have left the space, right? It's been so inconsistent these last few years, so the bar is very low for energy to work again.
Another big theme this week, and certainly over the last year, has been the stampede into Japanese assets. The Nikkei, for instance, rose 27% last year, the third straight year of gains. In 2023, gained 19%. People just kind of discovering the corporate Japan story. But now we have a lot of concerns about the weakening yen and the path ahead, especially since there seems to be a speculation that the U.S. and Japan are teaming up to intervene in the currency market.
Yes.
How are you thinking through all this?
So what I think is the easiest answer here is it's hard enough to get the market direction of stocks right? Now we're adding in the FX variable. So you got to go 2 for 2 to get this right. I think if you're going to allocate to Japan, let's just say you have $100 to add to Japanese ETFs, $50 to hedged, $50 to unhedged. Just take the FX out of it. Yes, you may sacrifice some upside depending on which way the currency goes, but at least you're there. So, maybe this ends up breaking something. I'm not quite sure what's going to happen with Japanese rates and the FX market. Yeah. So just try and take those questions out of it. I think you should still have Japanese equity exposure because of the corporate reforms, because it has defense exposure, machinery for AI, right? It's different than the U.S. where it's very much large cap growth. So just take it out, go hedge and unhedge. And there's ETFs for that. There's plenty of them.
Is there any other market where you have to think this carefully about currencies in the same way?
You could make the case if the euro ever ran away, but it's really Japan, I think, has been the one over the last decade where the returns, especially from if you just use DXJ and EWJ, where there's a massive gap. But now at this stage, just for the future, I think that's when you use the hedge-unhedged vehicles.
Yeah, absolutely. Japan, what is going on in the FX market there? It's certainly a rapidly changing story. It's going to be interesting to see where that one goes. Let's talk a little bit about private companies. Eric Balchunas, as mentioned, he's not here right now, but his team had a really interesting note out last week that you take a look at Ron Barron's new ETFs coming from Barron Capital, in particular, the Ron B fund. That is the ticker, Ron B, the first principles ETF. If you look at the holdings, about 22% of the fund is allocated to SpaceX. That's a private company. You have more than 5% of the fund allocated to XAI, another private company. And that turned a lot of heads, basically because the SEC has a 15% cap on illiquid holdings when it comes to ETFs. There's a theory out there that basically Barron is classifying these not as illiquid securities. And I just wonder what you make of the whole situation and what this says about where privates are going when it comes to ETFs.
So I have 3 questions and thoughts, basically.
Okay.
Are there going to be copycats? This is the second fund now with PE or third fund with PE, so it's very nascent. And if this fund starts to get inflows, that's clearly going to mean there's demand. The second thought is if I'm the Barron company, I'm not going to tell them what to do because they're clearly successful over time, but I would immediately put out information on what they're doing with this 15% cap. Because I agree. It was supposed to be 15% illiquid instruments. What makes this less liquid? Show me a visual, put out a white paper, anything. So that way people aren't scared. And then third, the strange part is when you look across the market, whether it's this ETF, XOVR, some of the private markets out there, the SpaceX pricing's all over the place. It's like a $400 spread. So what is the true price of this thing? I don't know. And I think that's still the hurdle for a lot of folks to get involved in ETFs that have private assets in it. They still don't see the proper valuations.
Absolutely. I'm glad you brought up XOVR. That's, of course, another ETF that does own a small slice of SpaceX as well. So I'm curious to know how investors might receive this, because on one hand, you have Eric Balchunas and Bloomberg Intelligence saying that this could be the setup for the next breakout active manager in ETFs, especially if we see these names pop. And then you have another take, which is from Connor McWilliams, saying that this sets a really bad precedent. This flies in the face of a lot of existing cornerstones of private market treatments in ETFs. And I just wonder, if this ETF really takes off, whether investors are going to really care about that. 2
of my favorite people. Number one. I've learned to not fight Eric, even though he and I will go back and forth some stuff. Connor's great. And I think that's where I go back to having Barron say, hey, this is why we can do more than 15%. Because I don't know. I frankly don't know how they got around it. I get they have mutual funds. They have existing exposure to SpaceX and some of the Musk-related companies, but they have to explain what they're doing here to investors. And so the real problem will be if something breaks, right? If liquidity dries up and all of a sudden you're diluting that SpaceX exposure and people want to know what it's valued at, I think that'll create a little bit of panic, not market-wide panic, but for folks involved in that fund. And that's going to be where transparency matters. We've had transparency in ETFs for 33 years. You cannot go less transparent. We already saw this with non-transparent ETFs. They flopped for the most part. So it's up to them to provide the transparency on how this is going to work.
It's kind of the hallmark of the ETF world, right?
Yeah, this is why people love it so much, along with the lower fees.
All right, well, speaking of transparency for ETFs, BlackRock's Rick Rieder is, one of the final contenders to be Fed chair, and he's been having interviews in Washington. Reportedly, they've gone pretty well. He's a regular ETF IQ guest, along with on Bloomberg Television. If he were to become Fed chair, if he were named Fed chair, what happens to BINC, the ETF that he manages with $16.2 billion in assets?
So let's see. BlackRock they have a deep bench, right? He's clearly the face of the fund, but this is key man risk, right? If you're out there touting this ETF managed by Rick and it's very successful, and then all of a sudden you lose it, I don't know. Maybe some people leave. This is key man risk, and I can't speak for what they're going to do. But I think it's super interesting. It's the same thing with almost a lot of other exchanges out there. Think of ARK. Kathy Wood is the ARK. She's the face of that company. What happens when Kathy says, you know what, I'm moving on, or whatever it might be?
Yeah.
Same thing with Ron Barron, right? And I know he has his kids. I think his sons are involved in the fund too.
Yes.
This is going to be really interesting over the next 30 years of all these established players coming into the ETF market. And you're going to lose these key man, key woman risks type there.
Yeah, the star fund manager has moved from the mutual fund industry to the ETF industry.
Oh, because they know where the money's going. It's obvious.
There you go. Well, it's going to be fascinating to see how it plays out. Maybe we'll get that announcement on the next Fed chair nominee this week. We'll have to see. But Todd, great to get some time with you. That is Todd Sohn of Strategist. Now, coming up, the firm behind T-bill has a proposal that could bring some of the Treasury market into tokenized finance. We'll discuss next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg's ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with Invesco. This is an interesting one. They're starting a new ETF for buying additional Tier 1 bonds in euros, AT1s. It's been an interesting space, certainly over the past few years. This is going to have a passive approach that's used by the firm's main AT1 ETF, and you can see the tickers there. And BlackRock also entering this space as well. So we'll see who really has the first mover advantage. But let's talk a little bit more about Europe, because we've been talking about Sell America. Eric really hates this theme, but he's not here. So you can see we're taking a look at European domiciled ETFs right now. So take a look at what's in the middle there when it comes to the US. You can see that flows into US exposures did slow down in 2025. That is the pink bar, but they certainly didn't go negative. So not exactly selling America, but maybe just buying less of it.
Oh, I like that.
Yeah, thank you. It just came
Buying less
from the heart. Let's talk about T-bill, though. This is an interesting one. So T-bill, it's enormously popular. It tracks really short-term treasuries, and FM is asking for permission to record existing shares on a blockchain. So sort of a tokenization type thing. Honestly, Scarlett, this one sort of breaks my brain, but luckily the reporter is here to tell us about it.
Yes, so let's bring in Bloomberg's Isabel Lee, who wrote about this. First of all, before we dig into this, what does it mean when they talk about tokenizing this ETF?
So tokenization in general is when you convert normal assets, stocks, bonds, even private equity, into shares that you just put in a blockchain. And they want this ETF share to be tokenized, so it will maintain the same bill, same regulatory structure, same disclosure, same everything, just that it's tokenized.
And so why start with something like T-bill here? Because again, you think about sort of the spectrum of excitement. Short-term treasury bills are on one end, and then I have to imagine things like the blockchain and tokenization are on the other.
I think on their end, it's the most liquid, and it's the biggest ETF they have. It's $6.3 billion. They have over 18 ETFs, or let's just say a dozen or so, and it's by far the largest. And I think that's what you need, especially when you do this, because why do you even tokenize? Many reasons. In theory, it's supposed to make settlement faster. ETFs are T+1 now. It's supposed to be instantaneous. Now you have, instead of the traditional piping of the NYSE, NASDAQ, or SIBO, it's on the blockchain, so you attract a new audience, and it reduces backdoor office work, in theory. So we have yet to see it in practice. I think it's the first, according to them, so it's really going to be interesting if the SEC approves it.
So does the issuer FM Investments actually need SEC approval, or can it simply move forward as long as the SEC doesn't flat out reject the proposal?
I think for this case, they do need SEC approval because they want it to be in the same system. Because we have reported on private credit funds tokenizing the same private credit funds, but then it's not listed in the exchange. So for this one, it definitely needs SEC approval.
And just very quickly here, does this change what T-bill holds or how it trades? I mean, for the user of T-bill, for the owner of T-bill, does it change your experience in any way?
Not at all. So for us, it's going to be exactly the same. It's like buying. The way they say it is, it's like a credit card. You just swipe and you shop and you buy. You don't really know how it works. So that's how sources I talked to say that's how they want it to work. They just want it to be seamless for the consumer or the investor without really knowing the back end. And in theory, again, I always say in theory, this is supposed to be more seamless.
All right, T-bill seeking permission to record existing shares on the blockchain, or at least the issuer of T-bill. Isabel Lee, thank you so much. Isabel, of course, one of our cross-asset reporters. She covers a lot in ETF land, so be sure to look for her byline on Bloomberg.com. Still ahead on ETF IQ, we speak to Michael Willis. He is co-founder and CEO of Cyber Hornet, on the firm's fund that marries traditional and decentralized finance. And just a reminder that you can listen to Eric Balchunas and Joel Weber on Trillions, their podcast that covers the industry. It's available wherever you get your podcasts, Apple Podcasts, Spotify, Google Podcasts, wherever. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. So let's do that right now. In the hot seat, we have ticker BBB. That is the Cyber Hornet S&P 500 and Bitcoin 75-25 strategy. As you can see, this tracks the weighted return performance of a multi-asset strategy that consists of a 75% weight in the S&P 500, a 25% weight in the S&P CME Bitcoin futures here. You can see that it has about $7.5 million in assets. It launched at the very end of 2023, and it charges about 95 basis points. Let's take a look at the holdings here. And as I said, basically it's futures. When you take a look at these Bitcoin futures, and then you have a lot of your S&P 500 names, as you would expect. What's interesting here is that if we take a look at performance, I've compared this fund's performance since its inception to the S&P 500 and also to IBIT to measure against Bitcoin. And you can see in that time, it has slightly outperformed the S&P 500, 54% or so over that period. The S&P 500, for context, higher by about 48%. Again, we're talking about total return. But then you compare it to IBIT, higher by about 94% or so over that time period. So really still blown away by Bitcoin, but slightly outperforming the S&P 500. Let's keep this conversation going with Michael Willis. He is the CEO and co-founder of Cyber Hornet ETFs. Michael Willis, it's great to have you with us. So talk to us about why this specific blend, 75% the S&P 500 and 25% Bitcoin.
Thank you, Katie. Sure. In 2024, when this launched, Bitcoin had an up year, and it, instead of 25% in the S&P 500, BBB did 39%. So you got an extra 14% by having the blend. Conversely, last year when Bitcoin had a down year, instead of being down 7%, BBB was up over 10%. So the methodology is sitting there for investors that are Bitcoin hesitant, crypto hesitant. They know it's there. They know it's an asset class they need to jump into, but they need a better structure, a little safer structure, more familiar for them to jump in. I think the first people into Bitcoin came in over the last 15 years, plus years. And then they didn't care that it was an unregulated market. Last year, the regulated people came in, and now you have the Bitcoin hesitant. So that's the reason for the 75-25 methodology, is just to provide a more stable base, but you have the crypto power.
It's like a starter investment for people who are, just exploring crypto. Why Bitcoin futures and not Bitcoin itself as the 25%?
We are converting to spot next week on this product, so we are moving over to spot. Initially, we didn't want to take the custody risk. We felt like there was a lot of single company risk, with Coinbase having the vast majority of all the coins, and we didn't mind the tracking error from the futures market. But as we moved forward, and as we're launching 4 new ETFs are scheduled to launch shortly here with the same 75-25 methodology, we decided as a company we wanted to move to the spot spacing and not have to worry about the tracking error from the futures.
And so you think about when you launched this ETF at the end of 2023, it was a much different world when it comes to, the average investor's socialization, education, and acceptance of crypto. Now in 2026, just the start of 2026, do you think that there's still a need for this fund to sort of, have this sort of hand-holding type relationship with people getting this crypto exposure?
Sure, we're still early. I think if you look at the Wall Street in terms of $100 trillion, about $3 trillion has come into the crypto space. So essentially, you have $97 trillion that are still sitting there, and there's a good chunk of that money that's going to continue to migrate into the crypto space. So I think they're the Bitcoin hesitant, and actually the third wave. I see the first two waves as being the unregulated wave, the regulated wave, and now that third wave is the Bitcoin hesitant, which I think a majority of those happen to be financial advisors who take a little bit longer to warm up to a new asset class, but they're gatekeepers of 30 trillion in assets. So I think from a fiduciary risk standpoint and helping clients get in for the long run, we believe Bitcoin's headed to $1 million over the next decade. So that's the long-term play. We want our shareholders to be able to take part in that, and we think giving them the S&P base is the smart play to do that.
Very quickly, Michael, would you consider using Ether, like launching an ETF where Ether would be part of the 25% instead of Bitcoin?
Yes, we are. And so we filed 4 new ETFs. They're set to launch shortly here, which is, I'm imagining, why I'm on today. But they, you will see we have a 75-25 ETH, 75-25 Solana, 75-25 XRP, and then a 75-25 crypto top 10.
All right, Michael, really appreciate your time. That is Michael Willis of Cyber Hornet. You can read all about this drill down and the latest in the ETF industry when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. And quick programming note, starting next week, we're going to be expanding this show to an hour, doubling the ETFs, doubling the fun. Definitely looking forward to that and hope you enjoy it as well. But that does it for Bloomberg ETF IQ for now. I'm Katie Greifeld along with Scarlett. This is Bloomberg.